Hi everyone, I'm Larry, and today we are breaking down a question that might sound simple, but is central to how the US financial system works. Why do banks still leave money at the Federal Reserve, even though the reserve requirement is 0%? And how does that connect to things like your mortgage rate or even why Silicon Valley Bank collapsed? Let's get into it. The federal fund rate, or FFR, is the interest rate at which banks lend excess reserves to each other overnight. It's managed by the Federal Open Market Committee, or FOMC, which meets 8 times per year to set a target range like 4.25% to 4.50%. Then, through tools like interest on reserve balance and open market operations, the Fed steers the market to keep the actual rate, the effective FFR, within that range. This rate is a benchmark for nearly all short-term interest rates in the US. Here's the surprising part. Since 2020, the reserve requirement has been set at 0%. That means banks are not legally required to hold reserves at the Fed anymore. But in practice, banks still choose to hold significant amounts. So why? There are three reasons. First is transaction settlement. Banks still need reserve to process payments through systems like ACH and FedWire. The second reason is a liquidity buffer. It gives them a cushion in case there is a sudden wave of withdrawals. The third reason is the Fed pays interest on reserves, so banks earn a safer return just by leaving money there. Think of the Fed like the central switchboard for the banking system. When Bank A wants to send a large volume payment to Bank B, it's not just a direct transfer. They both need to use their reserve account at the Fed. So even if the legal requirement is 0, banks keep reserves at the Fed to function. Otherwise, the modern payment system wouldn't work. Now let's talk about what happens when trust breaks down. In March 2023, Silicon Valley Bank had a large holding in long-term government bonds. But as the Fed raised rates, the market value of those bonds fell sharply. When depositors started pulling money, SVB needed liquidity fast. Here is the issue. Other banks refused to lend to them, even though the system still had plenty of reserves. Why? Because trust vanished. And in banking, trust is everything. Within 48 hours, SVB collapsed. It wasn't a reserve problem, it was a confidence problem. Now let's look at how this plays out over time. This chart shows the federal fund rate alongside average 30-year mortgage rates and credit card APRs since 2019. Notice a few things. As the Fed hiked rates starting in 2022, both mortgage rates and credit card interest shot up. Mortgage rates roughly track the FFR, but tend to be more volatile. Credit card APRs tend to lag a bit, but respond aggressively to rate hikes, often goes well above 20%. This is how monetary policy moves from the central bank to your wallet. So why should you care about the federal fund rate? Because its influence extends to almost every financial product. The first one is the housing market. Mortgage rates rise when the FFR rises, making homes harder to afford. The second is consumer debt. Credit card APRs increase. The third is business investment. Companies delay expansion due to higher financing costs. The fourth one is saving rates. Good news here. Higher FFR can mean better returns on cash and short-term bonds. In short, So FFR is a silent force behind your loans, your credit, and your savings. So even though the reserve requirement is zero, reserves and trust remain central to how the system works. If you have ever wondered how macro policy hits your personal wallet, this is where it starts. In the next episode, we'll look at how the Fed actually uses this rate to fight inflation and why the market often moves before the Fed does. Thanks for watching. See you next time.